Welcome to the daily update. I'll go through what happened on Friday, January 14th, and then look to see how things shape up for Tuesday, January 18th. Now, for some of you, these will be the first videos that you're watching where I go through my daily update. These are take one videos. You're going to hear me clear my throat because I have a bit of a hoarse voice right now. And this will probably be a little bit longer than what you would normally see in the daily videos. I just want to give you an idea of some of the things that I go through. I may go into a little more detail than I would usually do on the daily videos, but this is just to give you an idea of what I look at and how I approach analyzing the market from day to day. So what we'll do first is we'll just go through and recap what happened on Friday. We did have a gap lower open, and I'll have a intraday chart that I'll show you where we opened down, but then we immediately saw that gap filled. Not immediately, over the course of an hour, hour and a half. We went all the way back up to the unchanged level. From there, we dropped back down and went all the way down to S2, which is at about 46.17. We found a little bit of support at that level, bounced up off of that only to come right back down and test that area again. And at one point, it looked like things were really going to fall apart. Well, that area held, and because it held, we saw a lot of renewed buying at that level. And pretty much for the rest of the session on Friday, we were able to recover. We weren't up very much on the day based on Thursday's close, but if you look inside of what happened, it was a bit more positive. We only closed up about 0.08, 0.09%. But when we look at the daily charts, we are seeing continued weakness. This raging bull market that we've seen over the last 1 to 2 years with some setbacks, the charts are showing a little bit of weakness right now. Is this going to be just a short-term pullback and short-term weakness, or are we just seeing something normal before we resume the uptrend again? Or are we going to actually see a change of trend? You have people on both sides saying that this is just a pullback at this point, and that's kind of where I come out. Where others, anytime we have a down day, they're sure that this is the beginning of the end of the world. Volume on Friday was above average. And what the markets are fixated on right now, and I'll talk about this in a few minutes, is inflation. We're seeing a real pickup in inflation these days. We had the CPI that was released earlier in the week. And when inflation is going up, we also have to talk about interest rates, because that's what the Fed uses to try to slow things down and curtail inflation as much as possible. Also on Friday, we had a number of economic reports that were released. The big one was the retail sales report, and that came in weaker than expected. We had some other reports, industrial production and capacity utilization, as well as the Michigan Sentiment Survey, the preliminary version. Taken as a whole, these were seen as a little weaker than expected, and that helped to kind of cool down the narrative about inflation and interest rates, at least for right now. This could always change again come Tuesday. Another thing that we saw during the week is the dollar really got hit pretty hard earlier in the week. Well, on Friday, we saw a pretty healthy rebound. We dropped down below the 95 level with the dollar index. On Friday, we were able to come back and close above that. The current market valuation is that we're overvalued, but we've been overvalued for quite a while now. I've been talking about this for the last couple of years. Prices are way ahead of valuation levels. The stock market is a lot higher than it should be if you're basing things on earnings. When we look at our different charts, the trend condition is that we're not trending right now. So if you want to get into positions that gain when you go up or you go down, you may want to hold off on that for a little bit, where you might look at implementing sideways strategies, things where you sell credit spreads or something like iron condors. They may be more beneficial to you right now. Now that can always change. We can switch into a trending environment, but we just have to take this day by day. On a short and intermediate term basis, we are looking pretty negative, but from a long-term basis, we're still positive. There hasn't been any real serious damage done on the long-term charts yet, and I'll show you some of those as I go through this video. One thing to be aware of: on Monday, the stock market is closed in observance of MLK Jr. Day. It's a federal holiday, and trading will then resume again on Tuesday, January 18th. So let's look at the day's session. What happened on Friday? First, I look at sentiment. And at the end of the day, there's a measurement at CNN Money, and I take a screenshot of this every day. And this just shows us that we're pretty much neutral as far as fear and greed. Well, that's nice. And we have this pretty little chart here, but what does that really tell us? There's no context to this chart. So what I do is I look at the next that gives us historical values of this index. And we look way over on the right-hand side, and we're in the middle right now. Where we really start to take notice is if this goes above 80, that means we're in an extreme greed environment. Prices are going high too far, too fast. And if we drop below 20, that means there's a lot of fear. Prices are going down, and we're going down too far, too fast. But right now, we're just about in that middle part. So we're not seeing anything extreme right now. Another thing that I look at is called the VIX. And this is another name that I call this is the fear gauge, where when this indicator goes up along the bottom, that means there's a lot of fear in the market because you have people that are hedging their positions, buying options to protect themselves because they're afraid if they don't protect themselves, they're going to have large losses. Well, when the VIX gets very low, that means that there's not a lot of fear in the market. And for a long time, I used to use static numbers. I would use 20 as the upward band, and then I would use 12 as the lower band, meaning that we're very complacent. There's not a lot of fear. Well, on this chart, you don't even see 12. We haven't had a real complacent environment for quite a while now. We have seen a lot of fear. And because this static number, it doesn't really help us. We've spent a lot of time above 20 with the VIX. So what I also do is I plot some moving averages just to help see what is this doing over a period of time. Well, on Friday, we saw a little decline in fear, and the moving averages are heading down ever so slightly. So we're not in a real high fear environment at this time, according to this chart. Then I go through and I look at some of the sectors, and there's 11 sectors that make up the S&P 500. I go through this chart and then I organize it based on the percent change. And on Friday, since it was overall negative, at least on a closing basis, what we're seeing is a lot of the technology stocks, consumer discretionary, they got hit pretty hard on that day. We're seeing this real tug of war going back and forth. For the last couple of years, people have been in growth stocks. And what makes up a lot of growth stocks? Technology. Well, if we're getting into an environment where interest rates are being raised, a lot of investors will switch. Instead of being focused more on growth stocks that tend to do really bad when we start going down, they get more into value stocks that tend to perform less bad, if not even well, during those kinds of environments. And that's the tug of war that we're seeing. Growth versus value. There were 3 sectors that were up on Friday. You have consumer staples. This just covers things that people have to have regardless of what's actually happening in the economy. Toilet paper, food, toothpaste, things like that. Also industrials. This is what we use to actually build products. And then the utility sector had a pretty good day on Friday. Then I show it more in a graphical format. And all I did is I went back to December 31st. And as each day goes forward, this chart will be added to, and it will become a little clearer. But as of right now, the best performing sector is the energy sector, right here in about the middle. Other things are still trying to figure out, because when we're in a growth environment, some sectors do very well. When we're in a more value or negative environment, other sectors tend to do well. So we like to keep an eye on this just to help us understand what's going on under the hood within the S&P 500. And normally I would take out my throat clearing and so forth, but I'm using different software. I've done about 25 takes of this video and I seem to mess up along the way and stop recording. Well, you're kind of going to just get what I have right now. As I mentioned, we do have inflation that people are really focusing on. Earlier in the week, we had the CPI that was released and inflation came out at about 7%. That's higher than we've seen since about 1982. Well, that's what they're saying in the financial media, and that's a correct statement, but it's a completely useless statement. At that time, the context back in 1982 is we were in a very high inflation environment and inflation was overall coming down. Well, now we're in an environment where we've been in a low inflation environment for about the last 20 years or so. It's peaked its head from time to time, but we've really tried to keep inflation under control. And now we're going up. You throw all this stimulus into the market, you have all these policies like modern monetary theory that's being implemented by the US government, and you're just seeing a real potentially inflationary environment. And people were saying that at the time this was being implemented, but the inflation didn't necessarily show up right away. So people are saying, well, this is more transitory. It's only going to last for a short period of time. Well, we're seeing such an increase in inflation that they've dropped the word transitory now. And now we just have to battle inflation itself, which means the Fed is probably going to have to come in sooner rather than later to raise interest rates to try to cool everything down. Well, one thing I want to mention on this chart is the red line that you see, that's the official number that we get right now. The blue line that you see on top here is this is how the CPI was calculated back in 1990. They like to rework the economic reports from time to time so that things don't look as bad, at least when you look at the number, as they really might be. Well, if we used the same way that they calculated this back in 1990, we would be up at about 11% inflation. Just to give you another little look at this, if we go back to 1980 to see how they calculated the CPI at that time, we're up over 15% as far as inflation. And that is, in some definitions, could be hyperinflation. That's really, really high inflation, especially what we've been used to over the last 20 to 25 years. We haven't really had to worry about inflation. People always talk about it and people are always afraid of it, but to actually see it play out, now we're starting to see that. And a lot of that is because of all the stimulus that's been thrown into the US economy. Another thing that I look at is a thing called the Baltic Dry Index. And I'm still trying to determine, is this a useful indicator or not? This measures the shipping costs for a lot of dry goods going from place to place, because if it costs more to ship these products, eventually that comes through to the products themselves, and that can produce inflation. Well, looking at the bottom here, after the COVID plunge that we saw, the BDI really started to go up. And this was following the scenario that, yeah, there's inflation coming along. Well, when we topped out, this is when inflation really started to get measured. We started to really see inflation as a problem. And ever since then, the BDI has been really dropping. Now, there are two scenarios that we can look at here. One is that this indicator really doesn't help us all that much. The second one is maybe the BDI is showing us that inflation is not as bad as what we're feeling it to be right now, at least according to this. In your personal life, you might be really experiencing inflation. We're talking here more on a grand economic scale. So we'll just have to see how this plays out. Another thing that we're doing is we're starting to get on what is called Fed Watch. We're paying more attention to what the Fed is saying. We're wondering, what are they going to do? Well, there's a couple of meetings coming up for the Fed. The first one is in January, on January 26th. And right now, based on this, they're predicting about 97% chance that the Fed will keep interest rates where they are right now. And that's pretty much what the financial media is saying these days. It's March that they're getting a little bit more concerned with. So we don't really have to worry about them raising interest rates right now. We do, and the next chart I'll show you is what they're predicting for the March meeting that they have. And the Fed is really supposed to do what the market's already telling it to do. Sometimes it gets ahead of the curve and the Fed does something and then the market reacts. But in a perfect environment, the Fed just looks at what's happening in the market and then they're supposed to react to what the free market is really telling them. Doesn't always work out that way though. This next chart shows you that in March, they're currently at about 83% probability that interest rates will be raised. So if we do get to that meeting and they do raise interest rates, it's not going to be a surprise, but the market's going to freak out anyway. And usually what happens during those times is the markets gyrate all over the place, kind of like they did during the COVID plunge. And then once everything gets done being freaked out, it'll go back to the trend that it was already in before. Well, during the COVID plunge, we were in an uptrend. Everything crashed. Everything seemed to be coming down and everything fell at that time. Well, once we recovered from that, we resumed the uptrend. And over the last couple of years, have had a pretty strong market. What's interesting about this chart that you see right now is that this actually fell a little bit on Friday. We were higher up into the 80s on Thursday, but because of the weakness of the economic reports that came out on Friday, this actually bumped down to about 83%. So we watch this every day. I report on this in my different videos, and we'll just keep an eye on this. And as we get closer, this will pretty much tell us what will happen at that meeting. Let's look at an intraday chart of what happened on Friday. And I use my cursor. We can see some of the action earlier in the week. Well, on Friday, we did gap lower. We filled that gap. We went all the way back up to the unchanged level. We came down to, this is S2 on Friday, bounced up off of that a little bit, came down, and right in here, right about mid-session, it looked like things were going to get ugly. Things were really starting to drop. This is when a lot of my doom and gloomer folks started sending out emails saying the end of the world is near. Well, that's not what happened. We were able to maintain this level, build some support, and then for the rest of the trading day, we saw a pretty nice recovery. On the daily chart, it doesn't look all that pretty, but the internal action that happened during the day was a lot more positive than just looking at the daily chart would have you to believe. And here is the daily chart. I don't have any indicators on this chart where we see this drop down, but by the time we closed, we were actually just a little bit higher. And then down along the bottom is the volume within the S&P 500, and we were just a little bit above average there. Then the next thing that I do, and this is one of the first charts I look at every day, is are we trending or not? If we're in a trending environment, we can do trending strategies. If we're not in a trending environment, we can do sideways strategies. Well, one of the indicators that I look at is called the ADX, average directional movement. There's a number of different ways that you can interpret this. If you're a little bit more aggressive, you see this black line right here. If that turns up and actually crosses above a 5-period moving average that I've plotted on here, some people say, okay, the trend is starting now. A little bit more conservative approach is if the line is below 20, a static number, we consider that to be a non-trending environment, where if we break above 20 and the higher this goes, that means the stronger the trend is. The one thing about this black line is it does not tell you the direction of the trend. It just tells you the strength or weakness of the trend. What we do is we look at the other two lines, the green line being positive and the red line being negative. And if the red line is above the green line, that means that we're in a negative environment. And that's where we're at right now. And this feeds into the negative bias that I'm talking about. So, but overall, I would say we're below 20 and we're below the moving average. So we're in a non-trending environment. This can change at any time, but for those of you that implement different kinds of strategies, this can be very helpful in determining what to do. Then I look at breadth. We look at advanced declines, new highs, new lows. This chart just shows us on Friday that, yeah, we saw a little bit of a negative action within the S&P 500 based on price. Most of the stocks did not recover. There were just a basket of stocks that did. The stocks that have really been leading the way for the last couple of years. One thing that's a little more positive, if you drop down below, this is the volume on Friday. So even though we saw a red bar, even though it's small, we did see a green bar and it's small as well, but at least it's positive. So a lot of the volume that was going into the S&P 500 was more positive. Then we can look at this on a chart over a period of time, and we're well above this moving average based on price, although it did turn down a little bit on Friday. And then down below, this is the volume going in. We're above the moving average. There's been a little bit of a divergence where we've seen price going higher. Well, volume has yet to go back and make a new high. But we've been seeing that for quite a while now because of the big boys, the Microsoft, the Tesla, the Google, the Apple, those stocks that are really driving the market right now. The other stocks within the S&P 500, they're not participating as much. And so that's why we're seeing a bit of a laggard right here. We keep an eye on this. We don't freak out about it, but we just know that at some point when things do turn, this was a warning sign that we had well before things started to turn negative. Then I also look at the AD ratio. When we're above this red line and the blue line is going above, that's positive. When we drop down below that, that's negative. We're coming off an extreme reading late in 2021. That's when we hit the all-time high in the S&P 500, and we've been dropping down ever since. And then this week, we saw a little up and down choppy. Pretty much, if you have an up day, this blue line will turn and go up. If we have a down day, the blue line will go down. That's why I consider this one of my shorter term indicators. Another thing we can look at is new highs and new lows. Yes, we did make new highs on Friday, but we're seeing a real trailing off with the new highs. We're not seeing a real big increase in the new lows, but we want to keep an eye on this. This gives us an idea of, yeah, the car looks nice, but now we can open the hood and look in the engine to see how things look. And then we plot this over a period of time, and this red line is actually dropped a little bit below the blue line, so that's slightly negative. And then we have a 10-day average of the ratio, and it is actually dropping down as well. So we just want to keep an eye on this. Things can recover, they can improve, but right now we're not getting a real clear picture. Let's look at some other short-term charts. This is what I define as days to weeks. What I do on this first chart is I take the same moving average. It's a 20-period moving average, and I plot a simple moving average, which keeps, when it's calculated, day one has as much weight as day 20. Well, then you have an exponential moving average where the more recent prices, they figure more into the calculation. And some people use this as a trigger, and I use this as well. When the blue line is above the red line, that's more positive. When the blue line drops below the red line, and especially if they both start to turn down, that's negative. Well, right now, we can see that the blue line has dropped below the red line, and we're going sideways at this time. And this also feeds into the idea that currently we're in a trendless environment. Another chart that I look at, and I put this on the short-term category or in the short-term category, because I usually look at the 20 period moving average first. We saw a real extreme reading near the end of 2021. We're working off of that, and we did see it decline just a little bit. This would suggest that we haven't really changed gears yet. If we're going to switch over to a longer term bear market going down, it's going to start in our faster indicators, the ones that change quicker. Right now, we can see this as just a normal pullback. Well, if that pullback continues, then it'll feed over into some of these other indicators that we have, where I look at the 50 period moving average down below. That's more intermediate term, and it had a nice high reading as well and has been showing some weakness. Where we really start to get concerned is if we see the 200-day moving averages not only drop, but really start to go down below this blue line. This blue line is the upper band, and we've been pegged at that upper band for the last couple of years. Another chart is the MACD. I know a lot of you probably use this indicator for a long time. I devoted an enormous amount of time trying to figure this indicator out. Sometimes it works really well, and sometimes it can give a lot of false signals. But looking at this, the black line is quite a bit below the blue line, and that is negative. And the histogram right here is down below 0. So this is more short to intermediate term, suggesting that we're in a negative environment right now. We can also look at a thing called the Swenland Trading Oscillator. This blue line at the top, that's based on price, and it's going a little bit sideways. The green line on the bottom is based on volume. We want to study price and volume together. Ultimately, we have to follow price. If price is going up, no matter if it makes logical sense or not, we have to follow that. But we can get some real insight by also studying volume. Another chart is the McClellan oscillator, and this is more short term. On a good solid up day, it'll be above this black line, which is 0. Above 0 is positive, below 0 is negative, and we saw a drop down below 0 on Friday. Another chart is the stochastic RSI. It's kind of taking stochastics and the relative strength index and putting them together. This thing gyrates all over the place. And so that's why I have it as one of my short-term indicators. When we had some weakness earlier in the week, we pegged down into this oversold territory. We bounced up when it looked like we might be recovering out of that, only to see renewed weakness. And right now we're back down into oversold territory. Sorry for the cough, but I'm not going to go through and edit this. Let's look at some intermediate term charts. And these are a lot of the charts that I focus on. I'll have more charts for intermediate term than some of the other areas. As I had the 20 period moving average earlier, well, here is a 50 period moving average, both exponential and a simple moving average. And right now we're seeing that the red line is above the green line, and that's a little bit more positive. We haven't really rolled over yet. If we see this red line really start to go down, we'll want to pay closer attention to that. Then we also have a thing called the price momentum oscillator. This is the indicator itself above, and it's clearly negative and trending lower. Well, up above, we have the PMO based on price, which is rolling over a bit, but it's still looking a little more positive based on volume. It hasn't rolled over at this time. Another PMO study that we can do is what are the stocks within the S&P 500 that have a rising PMO. And this, after coming off a real extreme reading, this is showing some decline. We also want to look at what are the buy signals within all of the stocks in the S&P 500. This has been trailing off as well. And then we also look at those stocks that have a positive PMO, and that has also been trailing off. So this feeds more into the intermediate term negative outlook right now. Then we have a thing called the bullish percent index. There's a type of charting. I don't have one in this video, but it's called point and figure. And it just calculates things based on price movement. It does not take time into consideration. Well, within the S&P 500, if there are a lot of point and figure buy signals generated, this chart will go up. If there are a lot of point and figure sell signals, this chart will go down. And we can see after having an extreme reading near the end of 2021, we're really starting to come down. And this really fell on Friday because of the early action that we saw. A lot of sell signals were generated that didn't really get taken away once we saw that recovery going into the close on Friday. Then this is kind of an interesting chart, and people like to look at this and go, ooh, isn't that pretty? Well, yeah, it's good if it looks nice, but we need it to tell us something. These are a number of different moving averages that we plot here, and it's a ribbon or rainbow, whatever you want to call it. And when we see a really strong environment, you're going to see all of these moving averages moving up and space between them. You can see back here in the COVID plunge, when we really went down, all these things started to roll over. But since everything went down so far so fast, we bounced up out of that and then recovered. And from about June or July of 2020, we've seen a really strong up market. Even when we've had pullbacks, retracements, or slight corrections, these moving averages didn't change all that much. Well, looking at where we're at right now, the moving averages, even though prices move down in below the 50-period moving average, the moving averages are still holding up fairly well. So longer term, this still shows a positive environment. Now, this can change, and if price continues to fall down, then these moving averages will roll over as well. But as of right now, we're still holding up. I also have a stochastics study. On the very top is a faster stochastics, which can gyrate pretty quickly. This also shows that we're negative. Then I have another stochastics kind of about in the middle where we're rolling over, and then the full stochastics, which are a little bit longer. After coming off an extreme reading, this is also heading lower, which suggests a more negative intermediate term environment. Then we have a thing called the vortex, and similar to the ADX, when this red line is above the green line, that means that selling is more powerful, and the green line is declining, which means buying is showing some weakness. So right now, this also suggests that things are slightly negative. Then another indicator that I really like is the summation index, and this goes hand in hand with the McClellan oscillator. We have it based on price above, where it's rolling over ever so slightly, which is negative. But one thing that's positive is the volume has not rolled over yet. So things could still recover from here. We still kind of have to treat this as a normal retracement at this point as far as price. Now that could change, and buying on the dips, which has been so successful over the last few years, at some point that's going to fail. Right now, this looks like another dip, but if we see a lot of increase in volume and increase selling at the same time, then that could change this whole picture pretty quickly. Then what I do on this chart is I have a number of different oscillators that just measure momentum and trend. And all of these, you have the MACD and this whole list pretty much are negative. I don't go through these all one at a time. I look at the MACD and the PMO, but some of the other ones, I just glance at them daily. They're calculated a little bit different. And so sometimes we get slightly different information from these different oscillators, but most of these are negative. Then we have the CCI, and this was developed for commodities, but we can also apply it to stocks or to an index, where at the end of 2021, we had an extreme high reading. Well, since then, we've dropped down and we're actually getting into oversold territory. So, but it can stay this way for an extended period of time. Just because we're down here doesn't mean we're going to bounce right back up. It could, but it just means that this indicator has seen the selling and that it's happened pretty quickly. And so at some point, we could continue to fall down, but we might see some kind of a bounce in the near future. Some different trading systems, and these are more just packaged systems that we can go through. This first one is the Elder system. And what's kind of neat about this is if you have green to blue bars, that's more positive. When they turn red, that's negative. Well, Thursday and Friday, these bars continue to be red. And to get back to a more positive environment, we'll want to see them turn to green, if not blue. And then we have a 65 period moving average right here. And we've been able to stay above that right now. And then there's a MACD below that we can also use to measure this system. And it pretty much was sideways from Thursday to Friday. This next chart is SAR, stop and reverse. And basically how you read this is when the dots are below price, that signals an uptrend. When the dots are above price, that's a downtrend. And we are still negative according to this chart. Then some different charts that I look at. We have the Heikin Ashi chart, which is a Japanese form of charting. And when we're negative, we'll see black candlesticks. When we're positive, we'll see open candlesticks. And right now, these are negative. And I can never remember the name of this chart, but this is also showing a little bit of negativity. And then the next chart is a Kegi chart. And this is showing a little bit of negativity as well. And then we have the 3-line break, which is also slightly negative. So you can see we're seeing a lot of confirmation about short to intermediate term weakness in the market. Then here, this is an equivolume chart where if we have an open green bar, that's positive. If it's an open red bar, that's negative. Well, because we had an up closing on Friday, it's green, but you can still see it's trailing off. And then I have this ease of movement indicator down below, which is negative based on the 1 period calculation, and then 14, which smooths it out a little bit. That's also negative and heading lower, but we could be getting close to some kind of an extreme negative reading on this chart. Some of the longer term charts, and I really don't go through many on the daily videos. If something is telling us something, then I'll talk about it. But I usually do that in the weekly videos that I post. But we just want to compare in this section the equal weight S&P 500, taking all stocks and treating them the same. Or do we look at the S&P 500 as it's calculated now? Because it is a weighted index. When this black line falls down, that's the S&P itself. The equal weight, it's rolling over a little bit too, but holding up a little bit right now. Then I look at some broad market. I'll go into some other indexes. We have the Dow, or I'm sorry, at the very top, we have the S&P 500, which is what we've been studying right now. Then we have the mid caps, where this is a little bit concerning because we set an all-time high back in November. Well, the S&P hit an all-time high in December, but that was not confirmed by the mid caps, nor was it confirmed by the small caps. In a good, healthy environment, you'll want to see all of these making new highs at about the same time. And we haven't seen that. And a lot of the doom and gloomers out there have picked up on this, and they're seeing a non-confirmation, and that's why they think the end of the world is coming. This is a longer term version of that chart. It's the same thing, but it just shows you how these two tend to go hand in hand. They can get out of whack with each other from time to time, but we want to keep an eye on these. Even though we focus on the S&P 500, we want to look at lots of other indexes at the same time. This is a chart that compares stocks with bonds. if you've been a bond investor over the last couple of years, you're probably not very happy. Where you take the SPY, which is the ETF for the S&P 500, and then you take an ETF on the 10-year Treasury, and you really underperformed if you decided to get into bonds. When this line is going up, that's when you want to be in bonds. When this line is going down, that's when you want to be in stocks. If I could reverse this, and you would just see an exact mirror image of this, where stocks would be going up as bonds were going down. But I like to look at this all the time. We're way over here on the right-hand side. And it just shows that even though bonds have seen some strength in the last few days, the trend has not changed. Then we have the FANG stocks. These are the big boys, where they took them all and put them into their own index. And we saw some recovery on Friday, but overall, when we hit that all-time high at the end of December, we didn't come back to that. Its all-time high was back in November. So this is just showing a little bit more evidence that tech stocks are seeing some weakness. Then I look at the Dow. This is a short-term chart of the Dow. And we were able to stay above the 50-period moving average, which can be considered positive. There's also a pivot level where that has been acting as support. If we break through this pivot level, then we'll want to take notice of that. Here's a longer term view of the Dow, just to give you some context. See, we want to look at charts in a lot of different time frames, because we might see something on a long-term chart that we miss on a short-term chart. Then this is a little bit of what we call Dow theory, and I have my own way that I implement this. Here's the Dow at the top. Then we also want to look at the transports. We are seeing a bit of a divergence here. The doom and gloomers love this, but we can see divergences for a long period of time and then only to see things recover. And then I also include utilities in Dow theory, but the idea is you want to see all three, especially these top two, but all three of them move more in tandem with each other to show good, solid, broad-based strength. If you see weakness, we can also see that by looking at Dow theory. Here's the mid caps, where we're not seeing a lot of the strength. It did not make a high back in December, but we're still staying above the 200-period moving average. But we want to keep an eye on this. And then here's the NASDAQ, which are all of the stocks on the NASDAQ. Kind of the same story. We're seeing some more weakness, but we so far are staying above the 200-period moving average, but we're starting to see the 50-period moving average roll over. And then this is the NASDAQ 100, the biggest 100 stocks within the NASDAQ. Again, we're seeing some weakness. The 50-period moving average is starting to roll over, but we're still above the 200-period moving average. We made that high back in November, but we did not make a high in December. We got close, but intraday, you can see this bar, even though we finished down on that day, we're not seeing a lot of the strength in the NDX that we're seeing in the S&P 500, or at least had been seeing. And then these are all the stocks on the New York Stock Exchange, the NYSE Composite. And this is actually a little more positive. Yes, we're off of the high, but we haven't come down and tested the 50-period moving average yet. The moving averages are far apart from each other and they're not really rolling over. But we want to keep an eye on this because this could change. But this is a really broad measure of the market. And here's a longer term view with some moving averages placed on here as well. And so this is just a normal retracement at this point. Then here we have the Wilshire, this is the Schwab. It's really hard for me to read the names on here. This is the Schwab Total Stock Market Index Selective ETF. And I don't have any studies placed on here, but we can see that we made the high back in late December, but have been falling off. right now. So this gives us a real big picture look. Then the Wilshire, this is what I thought I was coming to next. This is, even though it's the Wilshire 5000, I think there's about 3,000 stocks in this index, but this is a very broad measure of the whole stock market where we made more of a double top going from November into December. We saw some rebounding on Friday. The 50 period is starting to roll over, but it's not showing a lot of real weakness yet. Here's a longer term view of that same chart. Then we have the MSCI, which we can look for the all world. This is an index that was created to say, what are all of the stocks over the whole world doing? Well, this is a little bit misleading because the US is number one. So if the US does well, other stock markets tend to do well. Not always, but as a rule. And so we're still maintaining above the 50 period moving average on this chart, even though we've seen some short-term weakness. And these are more trending. This is the KST. This is another momentum oscillator, where in China, they're seeing a pretty good uptrend. In the emerging markets, they're seeing an uptrend, as well as in Europe, and then in Japan. And the S&P is really showing a lot more weakness compared, I wouldn't say a lot more weakness, but showing some weakness compared to other country indexes. It's rolling over a little bit where some of the other indexes are holding up a lot better. This is a slower indicator, so we avoid a lot of the whipsaws, but it might take some time for this indicator to update as well. Then I go out and I look at the broad market. I look at things like copper. When you are seeing a real recovery in the economy, they call it Dr. Copper. And some people say, no, we're more silicon based right now. We don't need copper as much as we used to. Well, other people say, yeah, copper is still just as important as it's always been. So if you want to start to see an economic recovery, look at copper prices. Well, into 2020 and throughout 2021, copper saw a really strong climb, especially after the COVID plunge that we had. But lately, copper prices have really been going sideways. So does that indicate that maybe the economy is not recovering as much? We haven't turned down in copper prices, so maybe that means that the economy is hanging in there. We just have to watch this unfold day by day. This is the dollar chart that I was looking at. This is a daily chart where we did drop below the 50 period moving average. After the COVID plunge over here, where this looks like an EKG right here, the dollar really saw a lot of weakness. As they were throwing all this stimulus into the economy, you saw about a 10% decrease in the value of the dollar. So that's added inflation that they don't really seem to count. So you have the inflation that we have, and then you have the loss in value of the dollar, and those two work together to make inflation even higher. Well, we came all the way down to this 90 level, bounced up off of that, came back down to 90. And for a lot of 2021, the dollar has been recovering nicely. The blue line crossed above the red line. Well, we're still seeing the moving averages are healthy, but we dropped below the 50 period moving average, and we're just above 95 as far as the dollar index. This is a weekly chart, and this is what I used in one of the other videos, and it just continues to update, where we were really fighting for quite a while that late 2020 into 2021, was this 90 level going to hold? When you start to drop below 90, and especially when you get down to 80, this is when they say death of the dollar. We're going to have the Amero. World as we know it is going to change, and the dollar is not going to be the reserve currency anymore. And that all may, let me back that up, that all may very well happen. But according to this, the dollar's been holding up well. It's not like the dollar is a magic currency. It's just compared to other currencies in the world, it's between it and the euro, are considered to be the two strongest currencies right now. You have the Swiss franc, you have the Japanese yen, but the euro and the US dollar are still the main players. Then lumber has been just all over the place. As we had the lockdowns, and you probably heard about this in the news, where lumber prices were just skyrocketing. Well, then we saw a retracement. And then starting last summer, we started to see a real climb in lumber prices again. And that could be very inflationary, especially if you're building houses. That's going to help housing prices to really increase. And if you have some projects around your house where you have to run down to Home Depot, you've probably seen a real increase in the price of lumber. And then the supply chain scenario also feeds into that. Then here, this is oil. And just to think about this, we actually dropped almost negative back in 2020 during the early part of the lockdowns. And we've shot all the way back up into the 80s now. And a lot of you are seeing that at the gas pump for sure. Then gold, I like to keep an eye on this. And this is one of the things that has been kind of strange. I know we have cryptocurrencies out there right now, but if we're in a really strong inflationary environment, that's usually when gold really shines, pardon the pun. But for the last year, gold has just been chopping sideways. We go up a little bit, we go down a little bit, but it's really not going anywhere right now. This is the ETF, GLD. And then silver. Same thing is kind of happening. Everybody's talking about that. You see commercials on TV, buy gold, buy gold. Well, yeah, gold is a wonderful thing. And there is a time that you should be in gold. But to think that you're going to buy low and sell high with gold or silver right now, it just hasn't worked out that way. Then we have the CRB index. This is the Commodity Research Bureau. And we really look at this to get other signs of inflation, where since the COVID plunge, the CRB has really been advancing. And we look at this all the time. So this scenario has already been playing out for about a year to a year and a half. So the idea that there's inflation in the market right now should not be a real surprise to us. It's a surprise to the people that just watch the financial media and don't really pay attention to things and don't do intermarket analysis. We've been seeing this whole scenario played out. So the fact that what's happening right now, as far as interest rates and inflation, is not really a surprise. Then I look over at bonds. And what I like to do here is I'll just go through and look at the yields. Where at the very bottom, you have the three-month bill. And then we have the 5-year note, the 10-year, which is really the benchmark. And that's what we pay attention to. And we compare with other countries. And then the 30-year bond. And we can see how interest rates have been going up and down. As bond prices go up, interest rates go down. And as bond prices go down, interest rates go up. They're an inverse relationship to each other. And then we also like to look at the yield curve. And this red area at the bottom, this is when we have what's known as an inverted yield curve. And I go through that in my class, and I have other videos that talk about that. But lately, we've seen the yield curve going higher, which would suggest more of a healthy economy or a growing economy. It fell back and it's been bouncing around, but it's still holding up rather well right now. So this just suggests that the economy is growing, but it may be growing too fast. And that's why they might have to put on the brakes by raising interest rates and stop all of their QE programs that they've been doing. And then here, this is where we compare them with other rates throughout the world, where the US is doing the best as far as return. Now, 1.7, that's nothing to brag about. You're not going to retire off of that. But when you compare it to the UK, when you compare it to Japan, and when you really compare it to Germany, they've had negative interest rates since 2019, which makes absolutely no sense, but it's a form of stimulus if you are an investor anywhere in the world and you want the best return that you can get in bonds, you're going to go to the US. Even though it's laughable, look at it compared to other returns that you would be getting. And then here's the World Bond Index. Now, this is based on price. So as these prices go up, interest rates go down. Well, we've seen a real decline in bonds, and that's why over the last year to 2 years, you've wanted to be in the stock market. Stocks have really outperformed bonds. Then as far as the economic calendar, this will get filled out, and I'll try to make this bigger on some of the next videos. But on Monday, we have the NAHB Housing Market Index. That's really the main economic report that comes out. And there's some other ones that come out during the week. And as those reports come out, I fill in what happens and I color code it, depending if it's greater than expected, less than expected, or in line with what was expected. But I'm still working on this as I had to redesign this. And so it may look different in the future than how it looks now. So our conclusion based on Friday's close, the S&P 500 is not trending. The short-term, intermediate-term trends are negative to a little bit mixed for the intermediate-term trend. And then the long-term trend remains positive. So what are we looking for on Tuesday? There's light economic data that's coming out. We are starting to get into earnings season, and that can really gyrate a lot of individual stocks around. So we're not trending. So if you implement sideways strategies, or if you have stocks, you may want to consider maybe selling some calls, doing some covered call writing to generate some income that way. But be aware that there's that real tug of war between growth and value that's going back and forth these days. So thank you very much. This is probably longer than usual. I don't have a clock running to know how long this video is, but that concludes today's video, and I'll pick up with things again in tomorrow's video.